Today I want to talk about a couple of companies that I think that these are going to be really cool. They should make for awesome analyses, and the reason is that both of them are kind of experiencing some turnarounds, which I think is kind of fun. Makes it really interesting, I guess, to look at, and it makes it a little easier, I think, to find stuff. Remember, I said probably the most difficult company to take a look at is one that just goes about its business year after year and makes money and plugs away and does a great job. So, first one on this list is Christopher Banks, or Christopher and Banks Clothing, I do believe, if I'm not mistaken. Retailer of women's apparel and accessories. So, yeah, kind of interesting. I think that's what Guess is, and Guess is another one of ours. You see some green things here, which should tell you that things are pretty good, but its operating margins a little weak. Um, you know, Obviously we got to be a little concerned about revenue, right? But look at that operating income from a minus to a plus plus. Net income, look at that. Huge, okay, huge. And earnings per share, okay, huge, beautiful increases. Okay, and that's just the down and dirty. You look at the competitors here, TJ Maxx. Some of these are foreign, that I'm not familiar with. This would be foreign because it's a limited, okay, fast retailing. But I think Christopher and Banks, like I said, Guess or some of those might be good comparisons. Relatively small company, market cap of only 215 million, so a relatively small company. PE is price to earnings ratio. Okay, I was just reading this morning that the forward-looking price to earnings ratio for the S&P is around 16 or 17. Okay, so a forward PE or price to earnings ratio of 22 is a little bit high. Okay, if that's all you were comparing, you would say that this stock's a little bit expensive. Obviously, that's not all we're comparing, right? Because you got to look at growth rates and maybe some other things, and maybe the fact that it's recovering wonderfully and showing good trends might be reason to actually pay a little bit more, relative to the earnings. So. Those are huge things to kind of look at. Everybody, you'll be remiss if in your own analysis you don't kind of mention the PE and where you're at and why it might be a little higher or lower, than what what the industry or what the whole S&P is at. Okay, I like to come and look at the financials here. And there's some impressive changes, for Christopher and Banks, and we already looked at the revenue. Dollar-wise, certainly wasn't that impressive. We saw that. Actually, it's gone from 455, and their year end must be January. Okay, down to 419. So it's actually decreased, and kind of a relatively steady decrease. So we would want to address that in our report. Actually as well. Okay, but then from there it's easier, I think, to look at the percentages, and we had a cost of revenue back here that was just 63%, really cranked up on us, right? So things got kind of expensive, and my guess is maybe what happened, and this is what you might have to tell me, is not so much that things got expensive, but they had to discount stuff to sell it. They had bad inventory, and so they had to sell it for lesser prices, and so obviously that would affect greatly your cost of revenue or your cost of goods sold. So then the gross profit, though, if you go from 2013 here to 2015, what a nice increase from 29% to 35%. I gotta know why, right? That's your job to tell me. Okay, operating expenses, here, while they had pretty good gross or pretty inexpensive cost of goods sold, they had really high operating expenses. So, when you get to 2015, they kind of put it all together, right? They got their cost of revenue back down to kind of some more historical levels, and they got their operating expenses down from where they'd been. So it gave them finally some operating income, which they hadn't shown better this last year, but even better this year. per share, or at least a big improvement, right, in earnings per share of about 28. So we'll see. The question that might be, and I would think that it would come up in their particular analysis or their particular annual report, is what are they going to do about revenues? Okay, what are they going to do about revenues? And I think that could be a hugely important thing for a company like this. Is how are you going to get those revenues back up to where you make more money if you can keep your cost of revenue or cost of goods sold and your operating expenses relatively steady. So, boy, yeah, my computer's just bogged down again. So for that, I apologize. Or it's going to do something. The little blue circle of change. I guess I'll start calling that the circle of change for that blue thing that's just floating around there. Okay. That's looking at its income statement, and there's plenty there, to talk about. I could probably write for 5 or 6 pages just about that, but I might want to go take a look also at their balance sheet and see where we're at there. Again, balance sheet, for whatever reason, I tend to look at the dollar numbers as opposed to the percentages. Income statement, the percentages kind of work nicely. Okay, here we go. Balance sheet. It's coming. Now let's take a look in the dollar numbers here and see what they got going on. Not a ton of cash, right? Cash equivalents, short-term investments, receivables. Not a ton of changes there. It's down from years ago, but they've improved the last 3 years. Property, plant, and equipment. So this is a company that obviously doesn't have a lot of capital assets. Okay, not a lot of capital assets. They didn't have a lot of stuff here, simply because, right, they didn't have any income, and now they have deferred income taxes, and so basically that's just an account that's at this point in time there, because they just finished their year, probably the taxes that they're going to have to pay. Okay. So equity, other long-term, so their total assets, total liabilities we got coming down here. They don't have a lot for liabilities. Their accounts payable are just kind of a function of their sales and whatnot. Look at that. They've kept long-term liabilities down to virtually nothing, and their total liabilities, so not, they don't have a hell of a lot going on, going on with their balance sheet, right? It has stayed total stockholders' equity, though. Ooh, maybe I was wrong about that, because they've had total assets that have been nicely increasing since here, right? Okay, and total liabilities that have been holding steady. Okay, and so they have had a relatively nice increase, yeah, in total stockholders' equity from 75 million up to 136 million as of this year. So yeah, that might be worthy of some comment. Okay, so that's a quick one. Let's go take a look at another one. And this is I had a lot of fun looking at this one, and the reason is I had a student who last fall chose the same company, ELY. ELY, which is actually Callaway Golf. It's ELY because it's Eli, I think, was the name of the Eli Callaway, I think, was the name of the founder, maybe. We'll start, since I'm on the balance sheet, take a look at where they're going with their balance sheet. This is another turnaround company. I don't know if we'll see it so much here on their balance sheet. We'll see. Stockholders' equity is actually, it's way down from years ago, but they had some hard times. They had some really hard times, and we'll take a look at that, right? Had a little bit of retained earnings. They had losses here, huge losses. Look at that. So they were burning through equity like crazy, okay, because their retained earnings account had decreased. Just this year, they actually were able to increase it, and that's why you see the stockholders' equity going down so substantially. Okay, and then we'll cruise up here, and I'm going to click over to the income statement, because they got some cool things going on that are just wonderful. I think this may be a company to take a look at as a turnaround. You know, if a person wanted to speculate a little bit, this might be a company that might be an interesting one to speculate. I shouldn't say my only concern, but one of the main concerns is that golf seems to have plateaued in terms of popularity. Now, that said, we'll take a look at the numbers first before we look at the percentages. But they're, the revenues, the last 3 years they've been able to bump it up a little bit. They've been able to keep their cost of revenue, and so we'll look at the percentages, but that looks like, even though revenue has gone up, their cost of revenue has gone down, okay, substantially, and so as a percent, that should be a wonderful thing, and we would see that in the gross profit numbers, right, from 248 all the way up to 358, so a huge increase. And even though their revenue has increased, they've also been able to reduce, if you go back to 2012, their operating expenses, Okay, so again, relative to the sales from at least this level, right, from at least 2012, which was kind of a low point, they've improved dramatically, both in terms of their gross profit and in terms of their operating expenses. And let's go take a look at the percentages. And we'll see it there, right? Look at that. I mean, we've gone from a gross profit of 30% to a gross profit of over 40%. That's impressive, okay? I got to know why. It's because their cost of goods sold are down, but why? Are they able to charge more? Are they able to get a little bit more than a premium for their products, or have they been able to control in some fashion the costs of the production, maybe, okay? Maybe they've outsourced to a different place. Maybe they've done some different things like that. Okay, and on the other hand, look what they've done in terms of their sales and general administrative expenses as a percent. Again, it's kind of cool looking at both, right? When we looked at the numbers, from this year to this year, it didn't hardly change. Okay, in terms of the dollar amount that they spent on sales and general administrative, it did come down substantially there, but let's go back to the percentages. So from this year to this year, the dollar amount barely changed, but they were able to reduce it by 1.5%. That's pretty impressive. They did that because it's relative to the sales, right? And so we can say that they've really done a nice job of containing costs here while growing some revenues a little bit. And from back here, obviously, they've even reduced some costs. So pretty cool. So now they've turned a profit, a small one, albeit a small profit, but they have turned a profit, which is kind of impressive. Interest expense kind of looks like maybe they invested some money, because they did have a bump up, and so you might have to go back and look at the balance sheet and see if they invested some money, okay, because they are paying a little higher interest than they were before. They don't have a lot of interest expense, and that's good. Other income expense, they had some other income back then, they had some expenses, but finally, after 1, 2, 3, 4 years, they actually had some income before income tax, and after 4 years, they actually had some net income after tax. So really, it looks like an impressive turnaround. I wanted to look at their debt thing on the financial statement, on the balance sheet, I'm sorry, see what we got going on there. I wanted to show you something on the front page too. I wanted to look at their liabilities and see if they actually perhaps took on some long-term debt. Oops, I got it in percentages. It looks like they did. Let's change it to dollars though, because it looks like they took on some long-term debt here. Yeah, look at that. They had no long-term debt here. So they made a strategic decision. Well, that had to be a big and tough decision, I bet you. And I'd want to go back to 2012 and see. Because look at that. They took on some long-term debt, $107 million of it, right? Okay. They must have had a lot of faith in the company, and it must have had a lot of faith that the investment would pay off. Maybe that's how they've been able to contain some of their costs. Maybe they invested in some more modern manufacturing. I don't know. Good things to tell me, right? Awesome things to tell me is what they do with the money that they borrowed. Okay. Gosh, I would have troubles writing a report on this company inside of 20 pages. I'm sorry that I have limited you to just 5 pages. I wanted to click on just to see about the bonds, see if they've, if that $107 million, if they issued bonds or if they got financing otherwise. And this will tell us, maybe. Yeah, look at that. They've got they're not rated, but they do have some bonds outstanding, right? They still have a lot of equity, but they do have debt. Okay. Apparently 63.2 million. Kind of midterm, we would call that, right? Because it's maturing out here in 2019 sometime. They issued it. It doesn't tell us. Coupon rate of 3.75. Okay, you look at that. The yield to maturity now is 0.86. So rates have obviously come way down since they issued it in 2012. They have. It's probably for a couple reasons. They probably had to pay a little premium at the time because Callaway was hurting. As they're getting closer to the maturity and as Callaway has turned it around, people are willing to accept more risk, and so they might invest in that, even though they'd only get 0.86. None of that has a lot to do with your report, but it's kind of some interesting information. So one other quick thing about Callaway, I found it kind of, it lists as its competitors. This, you got to be a little bit careful. By the way, its forward PE is 34.3, which again, remember I said, ooh boy, that seems kind of high. But again, it might be kind of high because it's a turnaround story, and people are expecting the earnings number, especially the earnings per share number, to really increase. Earnings per share, look at that, gone from -$2 to plus 20 cents. Well, plus 20 cents doesn't sound like a hell of a lot compared to -$2. It's a hell of a lot. Okay, that's a huge improvement, and if they continue to make that kind of improvement, then obviously that price to earnings ratio, if the price were to stay the same, would come down substantially. Like Carnival, that's a cruise line, right? And Priceline and Royal Caribbean. Obviously, those are not competitors of Callaway. Callaway's difficult to find the competitors, I'll tell you. You can take a look at, Nike makes golf stuff, but obviously that's not their main line. Titleist is owned by Fortune Brands, I think. It still owns Titleist. And so it's kind of difficult to find some companies out there that are strictly in that business. Dunlop is one. I was kind of looking at Dunlop as being one that a part of the company Dunlop actually is, but it's similar and might be as close to similar as anything that a person might find. So there you have it, a couple more companies today